I'm going to talk about the last year. So a year ago, I went over basically the history of the whole company. Tried to jam 8 years into 1 hour. Today, I'm going to go over pretty much the last year, kind of where we're at, and what we are going to do looking forward. So this is how I currently feel. 2025 was tough. There's a lot going on in the world. Does anyone else feel like consumer sentiment is in a weird place? Oil's at a weird place. Politics is at a weird place. Geopolitically, things are on edge. We thought we'd get 2 to 3 rate cuts. Now it's probably 0 or 1. A lot has changed in the last couple months. But this is what we ended up doing in 2025. So in 2025, we closed 583 loans for $122 million. And most of that business was the bar graph on the left. So the bar graph on the left is RTL loans. And RTL stands for Residential Transition Loan. And all that means is you are taking an asset from one state and you're moving it into a new state. So it's a temporary loan, typically 6 to 18 months. A lot of times it's a house that needs repairs that a bank might not want to finance, or they might take a long time to finance it, or they might not finance the repairs that the operator needs. On the right is DSCR loans. These are 30-year loans where the income of the property has to cover the mortgage on the property, and that is the main qualifying mechanism on top of a credit score and a background check. This is basically what we spent last year doing. And there's certain operators in the room. There's a couple driving here now. We got Ben in the room from Baltimore. Thank you, Ben. So Ben is a user of both of these products. So Ben, I'm going to ask you, I know you weren't expecting this, but how many bridge loans do you have right now, do you think? Yeah, total. Not just us, with every lender. 150 properties. 130 bridge. Yeah, bridge loans right now, where you're doing construction, fixing the properties. 40 bridge loans. Okay. So the market for these loans is sitting right there. That's what it looks like. Ben is an operator. He buys properties, he fixes them up, he puts a tenant in them, and then he goes to long-term financing. Ben is a professional operator, and there's thousands of people around the country that operate in our niche that are just like Ben. This is our historical performance. So looking back, as long as we've been doing this. So we're almost at 2,000 closings, about $380 million of loans funded. And again, the bulk of our business is that RTL product on the left. This is a snapshot of our current portfolio. You can see the concentration there is in the Southeast and in the Midwest. You can see our average loan amount is about $207,000. In our industry, that's quite small. You can see our average interest rate is just over 11%. And that's going to vary depending on who the sponsor is, the price we can sell, the price that the market is offering them, how much we want the deal, all these types of factors. For DSCR, you can see that our average loan amount is $225,000, and the average interest rate's around 7% for those assets. And we are closing in 31 states, but Florida is our busiest state, where we see the most of our current exposure. These are some statistics we pulled from our overall portfolio of about 500 loans that are currently going. So our average loan to value is 62%, median loan to value is 65%. The average loan term we sell is 11 months, median 12. Most borrowers get into a hard money or fix and flip loan and they tell you they're going to pay back in 3 months. And I'm just here to tell you the truth. The truth is 8.3 is the median, the statistical median of what we are seeing. Loan to cost is on the top right. So loan to cost does not measure our exposure against the collateral's value. It measures our exposure against the borrower's cash into the deal. So our average loan to cost is 79.6, meaning if we put in 80 cents into an asset in first position, the borrower's putting in 20 cents. Now operators like Ben are going to negotiate against us, and we're going to have to go a little higher than that to earn his business, but this is our portfolio average. Our average experience is, our median experience is 4. The median's a better measure there because certain operators have hundreds of deals, but the median is a good measure for experience. And then you have credit score. Our median credit score is 720. So this is what a RTL portfolio looks like for a small boutique lender in 2026. This is the current portfolio, okay? This is why we have a picture of Rocky on the screen, right? It's not easy, okay? People go into deals planning to pay us off in 3 months. Sometimes the deal goes over budget. Sometimes the market shifts. We have a great team in loan servicing that's going to work through these assets and try to mitigate losses. Obviously, we want everybody in the green, but if you're in the red, we have a loss mitigation team that tries to mitigate losses on every asset we originate. So this is the current portfolio as of the end of first quarter. And this is our historical performance for every RTL loan we've ever done. So basically, if I do 50 loans, I'm getting a house back. That's kind of an easy way to think about it, is if I do 50 loans, one house is going to come back or one short sale. But if you're in the note purchasing business, I wouldn't buy 50 loans and expect it to be passive income. You're probably going to have 2 or 3 headaches on your hands. You might end up owning one house. And that's if you do it as well as we do. So our job is to take anything that's not green in our current portfolio and make it green here, where we recover all of our principal. You can see we have a handful of short sales in yellow and a handful of REOs, is 24. Also, interestingly, you can actually make money on REOs. You don't go into the business planning on it, but on rare occasion it happens. So I just want to take a little bit to talk, I want to take a minute to talk about kind of where we're at in 2025. Obviously we have everything going on overseas. We got tariffs and trade. We've got consumer sentiment all over the place. We've got $6 a gallon gas in California, Doug? Yeah? We've got, housing that still remains unaffordable for a lot of first-time borrowers. I read a statistic the other day that the first-time borrower was in their 20s when I was born, and then it turned to 30, and now it's closer to 40. Think about that. The American dream, buying your first house, the average age is now 40 years old. That's kind of interesting. Capital's staying expensive. At the start of the year, all of the prediction markets and all of the analysts, everyone thought 2 rate cuts, maybe 3, maybe 1, maybe 4, but 2 to 3 is kind of where the consensus was. Now it's between 0 and 1. So, reminds me of this guy, right? Best investor ever. Be fearful when others are greedy, and greedy when others are fearful. And that's not to say that we're just charging into markets recklessly. But I want to use some of the fear to our advantage to originate the right types of deals. Ben's a great example, and I'll get into it later, but a lot of the institutional investors in Ben's market pull out of the market, and when that happens, there ends up being a pretty big opportunity for smaller lenders to jump in. So we're going to talk a little bit about the real estate market. And this is very niched down, guys. So this content is like extremely niche. These are the markets that gained in the last year, okay? And what's interesting about this list is it is the markets that I don't really like. I don't like Cleveland. I don't like Pittsburgh. I don't like Detroit. I am a Detroit Lions fan, but I don't want to throw our money into downtown Detroit. I don't like Buffalo. I don't like Philadelphia. I don't like Chicago. These markets historically have a bad rap of being sort of not very lender friendly, taking forever to foreclose, and not being the healthiest markets. But if I pull my bias aside and I read the data, these are the top performing major metros. I pulled the top 50 major metros and I ordered them by performance of last year. So there's a lot of surprising names on that list. These are our biggest losers. So Cape Coral, it's down 9%. Tampa, 7, Austin, 4, Jackson, 3. We live in Florida, right? We do a lot of deals in Florida. We don't want to see this. You know, maybe we have a bit of a bias towards trying to make Florida and Texas work, right? Pro-business, you know, pro-business states, good demand. So how do you explain this? It's kind of interesting. It's sort of the opposite of what we were thinking we would see 1 or 2 years ago. And I think what we're noticing is the Midwest and the Northeast are big winners over the last year. And the Sun Belt and the West are our big losers. And I think what's happening is we were oversupplied from the pandemic boomtown, and we're having a pullback on that phenomenon. You know, 3 years ago, everyone was moving here. It was crazy. And I think you saw the same thing in Texas, and we're seeing a rebound of that right now. So we're seeing a lot of people kind of move back to the Northeast, and not so much, people don't have to escape to Florida to do business. They had to do that during COVID, right? So that phenomenon is gone, and I think the market's reacting to that. So there's a lot of competition in our space, a lot of institutional capital in our space, and we have to make a lot of decisions. So this is what our market looks like. This is where all the capital comes from for investors. There's a ton of institutional money in our space. I had ChatGPT, Gemini, and Claude all do deep research on last year's securitizations. And then I kind of looked at it myself, aggregated it, and I put it into a list that I thought was reasonable. So I could find about 20 securitizations for bridge lenders. We think it was about $4.5 billion that we could verify. Normally it's self-published securitizations. The company will do it, then they'll put out a press release. But we think the estimated true market is $5 to $6 billion. A bunch of those deals were rated, some were unrated, and a lot of first-time issuers, 10 first-time issuers last year, which is pretty interesting. There's a lot of new players in the market. This is a list of a lot of the deals. If you're in the business, you probably crossed paths with some of these people. Some of our operators in the room have probably borrowed money from these guys. The fifth name on the list is Ellington Financial. It's a public company. They're an aggregator, so they buy our assets and then securitize. They don't have a retail front. And what's cool about them is that the head of their purchase program is actually going to be here this afternoon. So we're going to be able to meet him and learn about how they make decisions and how they create their strategy. So it's a very crowded market. It's a very competitive market, and we have to sort of figure out how are we going to live in this market. And what's interesting about our market is there's a lot of loans that are institutional grade that end up in your securitizations, but they all kind of look and feel the same. And then there's a pocket of loans that truly need private capital. If you're doing a loan that's an institutional grade loan, the economics aren't quite as good because those deals are extremely competitive, right? Ben is getting his money at 9% at probably 1 point. Am I right? Yeah, I know the market. But if Ben leaves his urban hub and goes to a rural market, Ben is going to have to pay 12 and 3. And that's because there isn't all this money flooding into his market. So that's the difference between institutional assets and assets that truly require private country club capital. So when we create our strategy, we're thinking a lot about trade-offs in the market. And I would love to sit here and tell you guys that all of our borrowers have 800 credit. The median is 720. And the reality is in the market, the higher credit score is, the lower your note rate's gonna be. And the lower your credit score is, the higher your note rate's gonna be. So the real art in what we do is figuring out where to draw the line. And this is kind of what keeps me up at night, because I don't know. That's the truth. Should the credit be 660? Should it be 620? Should it be 700? What if they put more money down? What if they have good experience, but they had a bad year last year? What if, what if, what if? The market selection also impacts demand. So if you're in a tertiary market, you're gonna have less sales. If you're in a core market, you're gonna have more sales. But if you're in a core market, you're gonna have more demand, meaning your yield goes down. If you're in a tertiary market, you can make higher returns, but you're taking on more risk. Same thing with loan size. Same thing with complexity of project. Same thing with borrower experience. If the borrower's new, you can charge them more. If Ben, he's getting his money at 9 and 1. So that's cheap capital. A new borrower, I can probably charge him 10 and 2, 12 and 2. And the question is, should I take a chance on the guy with 1 or 2 deals, maybe his first deal, or should I keep working with Ben because he's reliable, predictable, he's a professional operator, but then make a lower yield per loan? Same thing with down payment. So this is the continuum of risk. And what I try to figure out is, where do we draw the line on each risk metric? And we want all green, everyone does. But when it's all green, it's an asset that earns 8, 8.5, 9%. But let's say credit's perfect, good loan size, easy project, great experience, borrower's putting money down, but the deal's in Wauchula, Florida. So one thing is a little bit off, and all the institutional money pulls out because they don't understand Wauchula, Florida. It's a little rural. I think that's where we could step in. And I'm not telling anybody anything they don't know, but if you take on low risk, you're generally gonna see a low return. If you take on massive risk, generally over time, if you do it well, you'll see a high return. This is what we try to do. We try to live in the gray, draw the line in the right spot, and create value for our limited partners and our borrowers by finding out what are the right types of deals. I spend a lot of time evaluating edge cases, figuring out exactly where to draw the line to create as much value as possible for our partners. If you're new to central lending, this is what we do. First liens only, title insurance, property insurance, and a borrower's down payment. That's how you're secured. That's the big 4. So first liens only, we get title insurance to make sure our lien is valid, it's recorded properly, property insurance to take care of it if it burns down, and a borrower's down payment to shield our equity and align our interests appropriately. Now this is probably new to many of you, but most of our underwriting decisions and most of our losses, if we do take them, is most of the losses in this space are some type of fraud. It is a borrower in a bad spot selling a house to themselves and hiding it from you. It's the title company that isn't real. So the majority of our underwriting is in preventing fraud, because that's where you take the big losses, and those are the mistakes you just can't afford to make. And 25% of our underwriting is in keeping borrowers out of trouble. And I think a lot of people that aren't in the business probably invert this. They'd probably say 75% is, let me micromanage the budget, look at the values, tell the borrower about the market that they're in. It's not that. It's, let's align interest properly, deliver capital to good operators, and make sure nothing weird is going on. I think one of the biggest changes we saw in the last year was technology. I don't know if anyone's following the AI stuff. It's coming very quickly. So we actually dove in and we tried to think what makes us different, right? We've raised our own capital, we have a pretty good model, good team, quick to deploy. But one thing we've been building out over the last year is a custom loan origination system. So it's easier than ever right now to build your own software. So we are on Claude Code, and in 6 months, we've built essentially a state-of-the-art loan origination system, something that would take giant teams years to do. We did it in 6 months with one guy. All right, you can submit your deal. You can get pricing in 30 seconds for any scenario. You can upload your documents. You get a full track record. And I'm in the middle of storing the files on Amazon Web Service, and then I'm in the middle of having AI read the docs and speed up our revision times. So that's what we're building out. And we're also using Claude Code and a lot of AI to speed up our workflows. And I think the sentiment here is, I think everyone's a little nervous when it comes to AI. I think the perception is AI just makes the decision. And let me tell you, it's anything but that. There's something in Claude called skills. Has anyone used Claude skills? Maybe? 1, 2, 3, 4. Oh, yeah, well, my team, obviously. I'm making it happen. So if you haven't used Claude skills, it's a pretty remarkable technology. And I actually prepared a little video about a Claude skill called a loan analyst. It's something that we built here to analyze deals and to speed up our research process. So I'm going to let the video roll, and it's about 5 minutes long.
Today I'm going to go over the loan analyst skill. So what this skill does essentially is this skill will find the loan in our ecosystem. It will look for the credit memorandum, which is the narration of the deal to make sure we understand the deal. And a credit memorandum is essentially, what do we need to know that isn't obvious from the numbers? Then we're going to look up the borrower, and if we've run their credit and background, it's going to include that in the analysis. If you haven't run their credit and background, it's going to say, hey, proceed with caution. We still need to check these things. Then we pull all this data from the loan. Then it reads our guidelines, reads the transaction type. There's a lot of details in here, but I want to skip to a pretty cool part of the analysis, which is the market research. So we're researching Zillow, Redfin, all those websites that could tell us what properties are selling for in that market. Then it's going to build us a comp table of as-is properties, repaired properties. Then it's going to build a grid of those comps and rate the confidence interval of how like for like these comps are. So recency, location match, size of match, condition, and did you have 1 or 2 comps, or did you have 5 or 6? And based on all this data, it's going to give us a confidence score for the comps. It's going to build out that table. Then it's going to do a market forecast. It's going to search the market that the deal's in, identify the top 3 to 5 employers and industries, figure out if it's a small town with a single industry with concentration risk, or if it's a balanced economy. It's going to look at days on market in the area, population, if there's like a surge in new building permits. So that's the market forecast outlook. And there's a lot of detail in here that I could spend 30 minutes covering this, but just wanted to show that this is a cool way to very quickly perform a particular task. At the end, we score the loan based on the market research, how complicated the rehab is, did they take out the maximum loan that they're qualified for, or are they okay with less than maximum? Is the deal profitable? And if so, how profitable? What's the credit score profile of the borrower? What's the experience of the borrower? What type of property? Where is it? Is it in a suburban market, or is it in a tertiary market with maybe not as many sales or not as much demand? And then how simple is the transaction? Are we purchasing off a seller at a good price, or is this like a confusing refinance scenario? And so the skill will basically give us a recommendation, move to the next step, decline the scenario, or send it back with questions. And so what I want to show you guys is and it also reads our guidelines, of course, which is very important. And what the scenario does is I'm going to show you guys a deal where the analysis was run. So you see, this is what the final result looks like. And so I look at these scenarios a lot. And essentially the skill was run. It's analyzing this deal, which is a ground up construction in Citrus, Florida. Um, it's basically saying the deal's not profitable enough. But there's a lot of good things with this deal. Repeat borrower, great credit, great experience, strong market. Um, so, and here's the comp table. These are the land comps. It doesn't agree with the stated value that was submitted of the land, so it's gave it a 64 out of 100 confidence score. And then here's the ARV of when the house is built. It gave this an 82 out of 100 in terms of confidence of agreeing with the submitted values. And essentially, the analysis is saying, strong operator, viable scenario, but your numbers are a little bit off. The deal just isn't quite profitable enough. So might need to lower the land as is value or lower the budget cost to make this scenario viable for funding. But that's how you can use sort of AI, use these tools to speed up your review process. It doesn't mean that, we're using AI to approve loans, but this is something that would have taken me hours, maybe days to compile all of this information, and I can get it back in 3 to 5 minutes. And so that really speeds up the velocity of my reviews and lowers our cost per unit closed, which is ultimately how we stay competitive in the market.
Yeah, so I'm on the 19th iteration. So what happens is I build it, run a deal through, it gives a review. The review's a little weird, I don't like it, and I'll just iterate over time. And I'm on the 19th version of this particular skill. You can actually build the skill in Claude itself. The prompt's very easy. It's build me a loan analyst skill. And it'll even make recommendations for you, like what types of loans am I analyzing? Who's my borrower? Like, it'll ask you questions so that it can help you give it the right answer to get to the use case you're looking for.
So how long do you think time-wise you put in?
I'm probably 5 hours into that skill, 5 to 10 hours. But it'll probably cut 100 hours of research out of the next year. Yeah. And it's better research. I don't want to look up if a market has one major employer or 3 to 5.
And is there like an error rate?
Of course. Yes, you have to. I think what I've learned is if you're using AI tools in your workflows, the person using the tool has to know how to do each underlying task that the AI is doing to at least be able to check the. So it's not a replacement for someone to just click buttons and get an answer. The person using the tool actually has to know how to do the stuff the tool's doing, and it just speeds up how quickly you get the result. And I think that's where we misapply it a lot, is we build a tool, hand it to someone, they're putting stuff in, the output is whatever, and no one can check it. And I think that'll get better, by the way. I think we're gonna get to a place where you can actually be pretty sure the outputs are good. Right now, we're very early, right? We're in dial-up internet phase.
So is it a thing where there's companies that have like an AI person that's what they do?
Yeah. It's me right now, but I'm looking for an integrator. Like, I need like a college kid that like geeks out on this stuff and is in the Reddit forums, and it's so frustrating because the younger generation, like, they're learning all this stuff that doesn't matter. They're learning how to become knowledge workers, and the knowledge is on the internet. You need to be an implementation, a problem solver. Like, those are the skills I think are gonna have a long viability.
Well, college should start to offer like AI courses.
Yeah.
It's funny, they don't want you using it, but now they're teaching you.
Well, everyone's using it anyway, so.
Today I'm going to.
All right. I do want to talk a little bit about how investors participate with us. But before I do that, I just wanted to mention and give kudos to the capital raising team. So over the last year, we raised $10,850,000. So give Kate and Heather a hand. Good job, guys. This is a great year for capital raising, and this is where the capital comes from that funds a lot of your deals. We've got 126 investors in our community, and our AUM is north of $40 million today. And basically, there's 3 reasons why investors invest. You have the tax shelter, which is I'm gonna go in on an oil field or some asset I can depreciate down, get a massive paper loss, offset some taxes. And if the cash flow isn't there, it doesn't really bother me. It's not my motivation. That's not what we do here. And actually, a lot of investors use their 401k to invest with us because the strategy's good, but it's not a tax strategy. So if you use a vehicle that already has a tax advantage, it can make a lot of sense. The third reason investors invest is for a return, right? I'm looking for 20% IRR. I'm going to go in on a syndication on an apartment, try to triple my money in 7 years, and hope it works out, right? Take out leverage, do the value add, hope it works out, and we'll see in 7 years, let you know how it went. We're sort of in the middle, right? We are a cash flow strategy, and these 3 strategies are all great strategies, and they all make sense for different people. What we've learned is our investor is a cash flow investor. This is where we are today versus last year. You can see the left versus the right. AUM is up strong. Investor capital's up strong. Our portfolio's up from 72 million to 113 million. Our REO rate, sadly, is clicking up. So a year ago, it was under 2%. Now it's 2.3. So I used to say, well, I just said it 30 minutes ago. I used to say you do 50 loans, you get a house back. Now it's like you do 45 loans, you get a house back, 46. We switched our investor platform, and we built our own loan operating system. So those are some of the changes we've made over the last year. Total distributions and note holder payments to investors. And these are the ways that investors invest with us. So as a note holder or being a member of the fund. And so these are the notes that we're currently offering in the second quarter of 2026. So a 4-month note, we're paying 7%. 12-month note, we're paying 10%. 36-month note, 11%. And a 60-month note, 12%. And of course, the longer terms are paying a higher rate because you're losing the liquidity and the opportunity cost of what might come up along the way. And the 4-month note is extremely liquid, and it's an administrative burden, so that's why it pays a little bit less. You're in, then you're out. So if you have a little extra cash, you want to park it somewhere for 4 months, have a maturity date, that's an option. Our equity investors get a pref of 9 and 75% a promote. So any income above 9%, they get 3/4 of it. Now, I would not recommend this unless you're risk. If you're scared of risk, I wouldn't recommend the equity option because equity investors are paid last and their returns are more closely correlated to the market. Our first fund, we had a year where we made like 1%. We had another year where we made a 24% return. So if you can't handle up and down, would not recommend this. This is our lifetime track record. So Fund 1, $250,000 invested 10 years ago. It's currently worth $809. It's a 223% return over 9 years. And then Fund 3, a $250,000 investment is currently worth $440. So there's my picture of Rocky. We're in a tough market. There's also a lot of news about private credit. There's a lot of news about private credit sort of getting shooken up right now, and it's a lot of business-to-business lending, but it's not real estate lending. So, and of course, this is where we're at now, right? This is 2026. So if you're ever wondering what you can do with AI, if you're sitting there bored on a Saturday night, just drop in a picture of yourself, drop in a picture of Rocky, and it did. Actually, this was Gemini, I believe. Actually, one of the AIs said they wouldn't do it because of like copyright or whatever, and then another one just did it. And I was like, what is going on? But no, seriously, it's been great talking to you guys. I appreciate all the support, and that's my time. All right, I'm going to take any questions. I don't know if there are any. But Jamie hit me with a few when I wasn't expecting it. Appreciate that. He's jumped in. So, hey, what's up, Jared? Heather, what's your capital raising goal for 2026?
We'll get to 42 million by the end of the year.
Nice.
From?
That's a good goal.
We're at about 28 right now.
That's solid.
When you look at our community, Lakeland, how does that comparison follow the same number? Does it follow the same stats you had on Florida in general?
Lakeland was hurting last year. Yeah. Lakeland's hurting. Down a couple percent. Mm-hmm. Tampa's down, Lakeland's down. Surprisingly, Orlando's been stable to a little bit up.
Okay, thank you.
What's up?
Thanks, Drew. That was great. Could you talk a little bit more, you touched on it at the end about the private credit space.
Yeah.
You hear that buzzword
Yeah.
being thrown around a lot. And, if you go on CNBC, it's like private credit problems, especially with some of the
Yeah.
Wall Street firms pausing distributions.
Yep.
Can you touch on the fact of what specifically is happening in that space that's not happening in your space that you can give investors some more confidence?
Yeah, so I've actually did a bunch of deep research on that specifically, created 3 slides. Didn't have enough space to put it in, but essentially you've got Apollo, I think, paused some distributions. BlackRock had a big run on distributions, and they just used their cash to fund them. And that's been repeating itself. And I think the common theme is it tends to be businesses lending to other tech businesses, $50 million loans, but not secured by any real estate. So real estate hasn't been, that's not to say it won't happen. Real estate can obviously have redemption requests and that sort of thing. But none of those news stories are in our niche.
Great, thank you.
Yeah, what's up, Frankie?
With the acceleration of AI, what do you forecast as far as the impact that has on staffing at the
Yeah.
human level now that you can do so much in so little time? And then also, you mentioned equating to where we're at on the timeline to dial-up internet. How quickly do you see us going from dial-up internet to Wi-Fi everywhere, so to speak, on the timeline with an acceleration at this pace?
Yeah, I would be extremely cautious about getting behind any type of business model that isn't at least having a AI strategy. So you can't just pretend it's not there. You have to have a strategy. It's either learn the strategy or have a business model that doesn't require technology, right? Like if you're doing events, for example, if that's your business model, you probably don't need a whole lot of AI. But if you're in the knowledge workspace, you absolutely need an AI strategy in your business, and you need to be very intentional about it. I think the reality is it's going to disrupt jobs, just like every major technology does. I think what's going to happen is you're going to have more super employees. Like right now, a loan processor can process 5-6 loans a week. And I think with the right workflows and with the right technology, one processor should be able to do 20, 30 loans a week. But it's if they use these tools extremely well, know how to use them. And getting from where we are now, getting to that place is kind of where the value creation is and where the opportunity is for me, right? That's the problem I'm trying to solve. Because at the end of the day, the market doesn't care about us. They care about, services rendered. Where can I get it the cheapest, the fastest, and the easiest? So we have a duty to deliver that product to the market as cheap and as efficient as possible. And if we're going to be serious about competing in this market, which is competitive, we just have to be very good at these things. We have to get extremely lean and extremely efficient. The market is not, Ben's not going to overpay for his money. Professional investors do not overpay for their money. So you have to find a way to, the country club private lender model is kind of going away as institutional capital keeps getting more and more in the market. All right, anyone else? All right, well, I think that's my time. I really appreciate you guys being here. So thanks, everyone.
Thank you.